October 1929. In a hotel lobby in New York, a wealthy investor named Joseph Kennedy is getting his shoes shined. The boy working the brush looks up and, unprompted, offers him a stock tip, something about Radio Corporation of America, a company the boy has never seen the inside of, based on a rumor from his cousin. Kennedy thanks him, tips him well, and by most accounts, walks straight out of that lobby and begins quietly selling off nearly everything he owns in the stock market. His reasoning, as he explained it later, was simple. When shoeshine boys are giving out stock tips, the market has stopped being about companies and started being about faith. And faith, unlike a company's balance sheet, can evaporate in an afternoon. Joseph Kennedy got out in time. Most of the country did not. It's a story that's been told many times, sometimes as pure anecdote, and historians have debated over the years exactly how literally to take it, whether it happened precisely as described, or whether it simply captures, in a tidy and memorable way, a broader truth about that moment. That by the fall of 1929, market speculation had trickled down so far into ordinary American life that even a child running errands on Wall Street felt entitled to an opinion about which stock was about to make someone rich. Whether or not every detail of the anecdote holds up, the instinct behind it, that widespread, uninformed enthusiasm is itself a warning sign, has become one of the enduring lessons economists still draw from this period, nearly a century later. This is the story of the Great Depression, how the most prosperous decade America had ever known collapsed into the deepest and longest economic crisis of the modern era, how the warnings were there for years before anyone acted on them, and how an entire generation learned, the hard way, that prosperity built on borrowed confidence is not the same thing as prosperity. Let's go back to the beginning. The First World War ended in November of 1918, and for the United States, which had entered the conflict late and suffered comparatively light losses, the years that followed were nothing short of remarkable. While much of Europe spent the 1920s rebuilding shattered cities and shattered economies, America surged forward. Factories that had been retooled for wartime production shifted seamlessly into producing consumer goods, and Americans, flush with new industrial wages, bought those goods eagerly. This was the decade the automobile went from luxury to household staple, thanks largely to Henry Ford's assembly line, which had already begun transforming manufacturing before the war, and now brought the price of a car within reach of an ordinary factory worker. It was the decade the radio entered the living room, turning isolated rural households into audiences for the exact same national broadcast, at the exact same moment, for the first time in American history. It was the decade of the refrigerator, the vacuum cleaner, and the electric washing machine, a wave of household technology that fundamentally changed how Americans lived day to day. Wages rose. Industrial productivity nearly doubled over the course of the decade. Electricity reached millions of new homes for the first time, and with it came an entire ecosystem of new appliances designed to be plugged in and paid off over time. Advertising itself became a more sophisticated industry during this decade, and its central message was, in essence, that the good life was not just possible, but expected. That any household without a radio, a car, or an icebox was somehow falling behind its neighbors. And crucially, for the first time in American history, stock market investment stopped being something reserved for bankers, industrialists, and the wealthy elite of New York and Boston. It became, in the truest sense, a national pastime. Consider how differently the stock market had been discussed just a generation earlier. In the 1890s or even the early 1900s, buying shares of a company was something done by a narrow, specialized class of investors, usually through a personal relationship with a private banker. By the late 1920s, that same activity was being discussed over breakfast tables in Ohio, in barbershops in Georgia, and in college dormitories across the country. The market had, in a real sense, become democratized, which sounds like an unambiguous good, and in some ways was. But democratization without financial literacy has a way of turning enthusiasm into vulnerability, and that is very much what happened here. Newspapers ran daily stock listings the way they ran box scores. Barbershops buzzed with talk of which company was about to take off. A popular joke of the era held that everyone from the elevator operator to the university professor had a hot tip on the market, and the joke wasn't far from true. Brokerage houses opened branch offices in small towns that had never seen one before. By the late 1920s, an estimated 1 in 10 American households held stock, a modest number by today's standards, but an explosion compared to a generation earlier. Fueling much of this was a practice called buying on margin. In simple terms, an investor could purchase a stock by putting down as little as 10% of its value in cash, borrowing the rest from a broker. If the stock rose, the investor could sell it, repay the loan, and pocket a return that, relative to their original 10%, was enormous. It was leverage in its purest form, and like all leverage, it worked beautifully on the way up and catastrophically on the way down, because here is the part that matters. Margin buying doesn't just amplify gains. It amplifies losses, and it does so instantly. If a stock purchased on 10% margin drops by just 10%, the investor hasn't lost 10% of their money, they've lost everything they put in, and they may still owe the broker the difference. By 1929, it's estimated that as much as 90% of the money flowing into stock purchases was borrowed money. An enormous portion of the market's rise was being financed not by real capital, but by debt stacked on debt, all of it resting on the assumption that prices would simply keep climbing. To put it in more concrete terms, imagine a clerk earning a modest annual salary who decides to buy $1,000 worth of stock, putting down just $100 of his own money and borrowing the remaining $900 from his broker. If that stock rises by 20%, his $1,000 position is now worth $1,200. He can sell, repay the $900 loan, and walk away with $300, a return of 200% on his original $100 investment. It's an extraordinary deal, and stories like this, repeated across dinner tables and social clubs throughout the decade, are precisely what drew so many first-time, inexperienced investors into the market in the first place. But run that same math in reverse. If the stock instead falls by just 10%, that $1,000 position is now worth $900, exactly enough to cover the loan, and not a cent more. The clerk's entire $100 investment has been wiped out completely. And if the stock falls by 20%, he doesn't just lose his $100, he now owes his broker an additional $100 beyond what his stock is even worth. This asymmetry, enormous potential gains paired with a very real possibility of owing more than you started with, was, for millions of Americans entering the market for the first time in the late 1920s, either poorly understood or simply not considered at all. And for years, they did. It would be easy to look back at the 1920s and imagine a decade of uninterrupted, evenly distributed prosperity. The truth is more complicated, and the complications matter, because they explain why the eventual collapse was so severe and so difficult to recover from. The first crack was in American agriculture. During the war, European farmland had been devastated by years of trench warfare, and American farmers had been called upon to feed the continent. They expanded their operations, took out loans to buy more land and equipment, and produced at a scale the country hadn't seen before. But when the war ended and European agriculture slowly came back online, global demand for American crops fell sharply, and prices fell with it. Farmers who had gone into debt during the boom now found themselves producing more grain than ever at prices that barely covered their costs. Throughout the entire decade that most Americans remember as an era of glittering prosperity, huge portions of rural America were already living through a quiet, grinding depression of their own. The second crack was in the banking system. In the 1920s, the United States had roughly 25,000 banks, and the overwhelming majority of them were small, local, and entirely unregulated by any federal safety net. There was no deposit insurance. If a small-town bank made a handful of bad loans to a struggling farmer, say, or to a local business that failed, and depositors got word of it, the result was often a bank run. A line of frightened customers demanding their money all at once, which the bank, having lent most of that money out, simply did not have on hand. Throughout the 1920s, an average of roughly 600 banks failed every single year, even during the supposed boom times. That number would look almost quaint compared to what was coming. A bank run of this era tended to follow a familiar, almost ritualized pattern. A rumor would circulate, perhaps accurate, perhaps not, that a particular bank had made a bad loan or was short on cash. A handful of depositors, unwilling to take the risk, would withdraw their savings just to be safe. Others, seeing the line forming outside, would assume the worst and join it, even if they'd had no prior concerns of their own. Within hours, an otherwise perfectly solvent bank could be forced to close simply because it physically could not hand out more cash than it kept on hand at any given time. Banks, after all, don't store the sum of their depositors' money in a vault. They lend most of it out to earn interest, keeping only a fraction in reserve. A bank run, in other words, could turn a rumor into a self-fulfilling prophecy in the space of a single afternoon, and it's a dynamic that would return again and again at a much larger scale in the years following the 1929 crash. The third, and perhaps most consequential crack, was the sheer imbalance in how the decade's new wealth was being distributed. By 1929, the wealthiest 1% of Americans controlled close to a quarter of the nation's total income, and the top 5% controlled roughly a third of it. Meanwhile, a large share of working-class and middle-class households were sustaining their standard of living not through rising wages, but through a new and rapidly expanding tool, consumer credit. Installment buying, the practice of purchasing a refrigerator, a car, or a radio in monthly payments rather than cash up front, took off during this decade. Household debt grew substantially throughout the 1920s. The prosperity on display in advertisements and storefronts was, for a significant portion of the country, propped up by borrowed money rather than earned surplus. There was a fourth crack, less discussed than the other three, but arguably just as important. The structure of American banking itself made the entire system unusually fragile. Unlike countries with a small number of large, well-capitalized national banks, the United States had thousands of small, independent local banks, each essentially on its own, with no mechanism to share risk or absorb a shock that hit one region harder than another. When trouble came, it wouldn't come as a single crisis at a single large institution that regulators could step in and manage. It would come as thousands of small, simultaneous collapses, each one deepening the fear that made the next one more likely. Put simply, a large share of the population had limited buying power once wages stalled. A large share of farmers were already in financial distress. The banking system meant to absorb shocks had almost no cushion to do so, and that banking system was structurally fragmented into thousands of institutions with no shared safety net. The market, meanwhile, kept climbing, increasingly detached from any of this. It's worth sitting with that disconnect for a moment. The stock market, in theory, exists to reflect the real, underlying value of real, underlying businesses. By the late 1920s, it had become something closer to its own self-contained economy, one that occasionally intersected with the actual production of goods and services, but increasingly moved according to its own internal logic of momentum, rumor, and borrowed money chasing yesterday's gains. None of this went entirely unnoticed. Economists, bankers, and even a handful of politicians raised concerns throughout the late 1920s that the market had become dangerously overheated. In 1928, officials within the Federal Reserve debated raising interest rates, specifically to cool speculative buying and discourage the flood of borrowed money pouring into stocks. Some argued forcefully that the market's rise no longer reflected the real value of American companies, but rather a self-sustaining wave of speculation, people buying stock not because they believed in the underlying business, but because they believed someone else would pay more for that same stock tomorrow. The Federal Reserve, in the end, moved cautiously and inconsistently. Raising rates risked slowing an economy that, on paper, looked stronger than it had ever been. No official wanted to be the one who ended the party. Some argued the market would eventually correct itself gently, a modest cooling rather than a crash. Others insisted the fundamentals were sound, and that concern was overblown entirely. Even respected economists got this badly wrong. Just days before the crash, the prominent Yale economist Irving Fisher, one of the most respected voices in American economics at the time, publicly declared that stock prices had reached what he called a permanently high plateau. It's one of the most infamous mistimed predictions in economic history, and it captures something important about this whole period. Confidence, by 1929, had become almost entirely self-referential. Prices were high because prices had been going up, and prices had been going up because prices were high. It was a loop with no anchor in reality, and very few people in positions of power were willing to be the one to say so out loud. Fisher's reputation, built over decades as one of the most rigorous economic minds in the country, was so damaged by this single miscalculation that it colors how he's remembered to this day, often overshadowing decades of otherwise genuinely important academic contributions. It's a useful reminder that expertise, on its own, is not immunity from the pull of collective optimism. Fisher himself had significant personal money invested in the market, a fact that likely shaped, whether he recognized it or not, just how badly he wanted his own prediction to be correct. This pattern, respected voices offering public reassurance, partly because the alternative was too uncomfortable to say out loud, repeated itself across banking, government, and the financial press throughout 1929. Newspaper columnists who had built their reputations celebrating the market's rise had little professional incentive to suddenly reverse course and warn their readers that the party was ending. Politicians who had taken credit for the prosperity of the decade had even less incentive to suggest that prosperity rested on a foundation as unstable as it did. The warning signs, in other words, weren't entirely absent. They were simply competing against a much louder chorus of people whose careers, reputations, and personal finances depended on believing otherwise. Meanwhile, the climb continued. The Dow Jones Industrial Average, which had sat around 100 points at the start of the decade, crossed 380 points by September of 1929, nearly quadrupling in value, with an especially steep run-up in its final 2 years. Brokers extended margin loans freely. New investors, many of them with no prior market experience at all, kept pouring in, chasing gains that had, for years, seemed almost guaranteed. It's worth noting that a handful of voices did try to sound a genuine alarm. A small number of financial journalists and bankers warned in print that speculative buying had detached itself entirely from underlying business performance. But these warnings were consistently drowned out by a much larger chorus of optimism: brokers, newspaper columnists, and public officials who had every incentive, financial or political, to keep the confidence flowing. When your income, your reputation, or your re-election depends on the market continuing to rise, there is a very human tendency to interpret every warning sign as an overreaction. That tendency was on full display throughout 1928 and 1929, right up until the moment it no longer could be. By September and early October of 1929, the market had already begun showing signs of instability, sharp daily swings that unsettled seasoned investors, even as the overall trend still pointed upward. Then, on October 24th, 1929, a day that would come to be known as Black Thursday, the unease turned into outright panic. Trading opened with a wave of selling that quickly overwhelmed buyers. Prices began falling fast, and as they fell, investors who had bought on margin started receiving what were called margin calls, demands from their brokers to immediately put up more cash to cover their loans, or have their stock sold out from under them to cover the difference. This, in turn, forced even more selling, which pushed prices down further, which triggered even more margin calls. It was a mechanical, self-feeding spiral, and once it started, there was very little anyone could do to simply talk it back into reverse. By midday, crowds had gathered outside the New York Stock Exchange on Wall Street, uncertain exactly what was happening inside, but sensing, correctly, that something had gone very wrong. Inside, the trading floor was in chaos. The ticker tape, the mechanical device that printed out stock prices as trades occurred, fell hours behind the actual pace of trading, meaning that for much of the day, nobody, not even the brokers themselves, actually knew the real-time value of what they were buying or selling. In an effort to stem the panic, a group of the era's most powerful bankers, including representatives from firms like J.P. Morgan and Company, met that afternoon and agreed to pool their resources, buying up large blocks of stock publicly and visibly in a deliberate effort to project confidence back into the market. It was a calculated gamble, and for a few days, it appeared to work. The market stabilized. Newspapers cautiously suggested the worst might be over. It was not. On Monday, October 28th, selling resumed, and this time there was no coordinated rescue effort large enough to stop it. Then came Tuesday, October 29th, the day that would be remembered as Black Tuesday, and the single most catastrophic trading day the New York Stock Exchange had ever experienced. Over 16 million shares changed hands that day, a volume so unprecedented that it would remain a record for nearly 4 decades. Prices didn't simply fall, they collapsed. Fortunes that had taken years to build were wiped out within hours. Investors who had been, on paper, millionaires at the opening bell found themselves, by closing, owing more money than they had ever possessed. Over the course of that single week, it's estimated that roughly $30 billion in market value vanished, a sum, in the terms of the era, larger than the entire cost the United States had spent fighting the First World War. The physical scene on Wall Street during those days has been described by numerous witnesses in strikingly similar terms. A kind of stunned, disbelieving quiet, punctuated by sudden bursts of shouting from the trading floor, messenger boys running between offices with slips of paper that were already outdated by the time they arrived, and outside on the street, crowds simply standing and watching the building itself, as though the structure could somehow explain what was happening inside it. Police were dispatched to manage the crowds, less out of fear of violence, and more because nobody quite knew what else to do with that many anxious people gathered in one place with nowhere else to be. What made the crash especially disorienting, even for experienced financial professionals, was the sheer speed of it. This was not a gradual, month-over-month decline that gave investors time to adjust their expectations. It was a compression of years of accumulated risk into a matter of days. Many investors who checked their holdings on the morning of October 29th and again that same evening found the numbers barely recognizable. It's easy, at this distance, to talk about the crash purely in the language of numbers: points lost, shares traded, billions erased. But behind every one of those figures was a person, a family, a set of plans that had, almost overnight, ceased to make sense. Contrary to popular legend, there was no widespread wave of Wall Street bankers leaping from skyscraper windows in the days following the crash. That image, while dramatic, is largely a myth exaggerated by the press and popular memory. The real devastation was quieter, and in many ways more corrosive. It played out over weeks and months, in modest living rooms rather than on rooftops. Consider the ordinary investor, not the wealthy financier, but the school teacher, the shop clerk, the small-town dentist, who had put a portion of their savings into the market on the advice of a friend, a relative, or a broker who assured them the trend would continue. Many of these investors had bought on margin without fully understanding what that meant in practice. When the crash hit, they didn't simply lose their invested savings. Many were left owing money they didn't have, on loans secured by stock that was now worth a fraction of what they'd borrowed against. bank failures compounded the damage. As the crisis deepened, banks that had made risky loans during the boom, or that had themselves invested depositor funds in the market, began to collapse under the weight of their own bad decisions. And because there was still no federal deposit insurance, when a bank failed, its depositors' savings often failed along with it. A family that had never touched a share of stock in their life could still lose everything, simply because their local bank had made poor investments elsewhere. By the end of 1930, just over a year after the crash, more than 700 banks had failed across the country. That number would climb dramatically higher in the years that followed. There's a particular kind of hardship that doesn't show up cleanly in economic statistics, and it's worth naming directly. It's the hardship of a family that, for the first time in their working lives, has to explain to their children why there won't be a Christmas this year, or why the family car, bought on installment payments just 2 years earlier during the height of the boom, has been repossessed. It's the hardship of a man who spent 30 years building a small business, only to watch his supplier chain collapse and his customers stop spending almost overnight through no failure of his own making. Contemporary accounts from this period describe a widespread, quiet sense of shame among the newly unemployed, a feeling, entirely undeserved but deeply real, that losing one's livelihood in a systemic collapse was somehow a personal failing rather than the predictable outcome of a financial system that had been allowed to overextend itself for years. In the days and weeks after Black Tuesday, the nation's leadership moved quickly, not to intervene aggressively, but to reassure. President Herbert Hoover, who had taken office earlier that same year on a wave of confidence in his own reputation as a brilliant administrator, told reporters that the fundamental business of the country was, in his words, on a sound and prosperous basis. Hoover's confidence wasn't dishonest. It reflected the dominant economic thinking of the time. Most economists and officials in 1929 believed the market operated something like a self-correcting mechanism. Prices had risen too far, a correction was painful but necessary, and once the excess speculation had been wrung out of the system, the economy would naturally rebalance itself. Government intervention, in this view, risked doing more harm than good by interfering with that natural process. For a brief window, this optimism seemed almost plausible. Industrial production dipped, but didn't immediately collapse. Unemployment rose, but gradually. Many Americans, reading the president's reassurances in their morning newspaper, genuinely believed the worst had already passed. It hadn't even begun. What made the crash so devastating wasn't the initial event itself. It was what the crash triggered in a financial system that had almost no capacity to absorb a shock of that size. Banks that had extended margin loans now scrambled to call them in, demanding repayment from businesses and individuals who, in the sudden credit crunch, had no way to pay. Businesses that depended on short-term credit to fund their daily operations, to make payroll, to buy raw materials, to keep the lights on, found that credit had simply vanished. Companies laid off workers. Laid off workers stopped spending. Reduced spending meant reduced demand for goods, which meant more layoffs, which meant even less spending. It was the same self-feeding spiral that had gripped the stock market on Black Tuesday, except now it had escaped Wall Street entirely and was tearing through the real economy, factories, farms, and family budgets across the entire country. And as banks failed by the hundreds, the crisis fed itself in yet another way. Each failed bank meant frightened depositors at every neighboring bank, which meant more bank runs, which meant more failures. It was a wildfire with no natural firebreak, and in late 1929 and through 1930, nobody in Washington had yet built one. It would be a mistake to think of the crash of 1929 as a purely American event that simply happened to have American consequences. The United States had, by the 1920s, become the world's largest creditor nation, having lent enormous sums to European governments during and after the First World War to help finance both the war effort and post-war reconstruction. American banks and investors had also poured money into Germany specifically, helping stabilize its economy after the ruinous hyperinflation of the early 1920s. When American banks, reeling from the crash and the wave of domestic bank failures that followed, began calling in those loans and pulling back new lending abroad, the effects rippled outward almost immediately. Germany's fragile economic recovery, built substantially on American capital, began to buckle. Britain, still working to rebuild after the war, saw its own financial system come under severe strain. Trade between nations, already slowing, was further strangled when the United States, in an attempt to protect domestic industries, passed the Smoot-Hawley Tariff Act in 1930, a sweeping increase in import tariffs that provoked retaliatory tariffs from other countries and caused global trade to contract sharply at precisely the moment the world economy could least afford it. What had started as a domestic stock market crash was rapidly becoming a global depression, with each nation's economic troubles feeding back into the others. This matters for understanding what comes later in this story, because the American recovery of the 1930s wouldn't happen in isolation. It would unfold against the backdrop of a world economy in comparable distress. And in some countries, that distress would give rise to political movements far more extreme and far more dangerous than anything seen in the United States. By the end of 1930, the picture looked almost unrecognizable from the confident, prosperous nation of just 18 months earlier. Farms that had already been struggling throughout the decade now faced total collapse. Hundreds of banks had shuttered their doors, taking their depositors' life savings down with them. Unemployment, which had sat below 4% before the crash, was climbing toward levels the country had never experienced in peacetime. And the man in the White House still largely believed that patience, confidence, and time would be enough to fix what panic had broken. It would not be enough. What had begun as a stock market correction was quietly transforming into the deepest, longest economic collapse the modern United States had ever faced, one that would eventually touch nearly every household in the country, reshape the relationship between American citizens and their government, and ultimately require a response far more radical than anyone in 1929 could have imagined. Hoover was not, by any honest account, an indifferent or uncaring president. He did authorize some federal intervention, public works spending, loans to struggling banks and railroads through a newly created Reconstruction Finance Corporation, but his interventions were consistently smaller, slower, and more cautious than the scale of the crisis actually demanded. He remained committed to the idea that voluntary cooperation between business, local government, and private charity could see the country through, and he resisted, almost until the very end of his presidency, the idea that the federal government should take direct, large-scale responsibility for relief or recovery. By 1932, with unemployment still climbing and confidence nowhere near restored, that resistance would cost him the presidency, and it would open the door to a fundamentally different vision of what government owed its citizens during a crisis of this scale. That response, and the man who would deliver it, is where we pick up in part 2.